Good afternoon.
Quite spread out.
Welcome to this session about navigating the North American landscape. My name is Katia Lévy-Thévenon, and I manage all the client relationships with Germany for the depository receipt team at Deutsche Bank. I'm delighted to introduce this workshop. As we all know, it is a market, North America is a market that cannot be ignored, and having a strategy for it that works for your company is greatly important. Our panelists will now cover a few topics for about 35-40 minutes, and then you will have an opportunity to ask them questions. As we will run a few slides to set the scene, I have to draw your attention to this important disclosure notice. But now that this is done, we can move over to the panelists. Firstly, just on my right, Patrick Tobias. Hello. Toby is Senior Vice President of Corporate Services Sales for Europe at iPrio. He runs the corporate sales team for IR services and business intelligence in Europe. On the far end side, Zafar Aziz. Zaf has been in the depository receipt team and the depository receipt industry for over 14 years and is currently responsible for a global team at Deutsche Bank providing value-added services to investor relations team. In the middle, Severin Kamp. Severin has two decades of capital market expertise. She co-founded Fairview Partners in 2014. Fairview Partners are a strategic capital market advisory firm providing investor relations advice to debt and equity issuers. Prior to this, Severin worked in investor relations at Mannesmann and Deutsche Telekom in Germany and at Thomson in France. Last but not least, in the middle, next to Severin, Rodney has been head of investor relations of Nordea for the past 6 years. Under his watch, the percentage of investors from North America in his capital has increased significantly. Prior to this, he was Nordic head of research at Cheuvreux, banking analyst at Alfred Berg, and a financial journalist. Now, before I hand over to Toby, I just wanted to give you a few key figures about the North American market, and specifically the US, which is extremely important. Overall investment in the US for non-US equities, 6.7 trillion, including ADRs. Around 20% of this, so $1.3 trillion, are estimated to be invested in ADRs. The US is a key market as an investment location. 65% of global fund management assets are based out there, as well as 60% of global hedge fund assets. Lastly, North American investors cannot be neglected. 23 trillion are invested in equity out of North America, when you compare that to 10 trillion invested by European investors altogether in European equities. Now, let's dive into more details. Toby, can you tell us a bit more about how the North American investors are invested in Western Europe currently and the latest trends?
Well, I will certainly try. Just to give you a bit of perspective where the data comes from or what we looked at. So basically this is public filing data derived from 13F filing, 13D and 13G, as well as data that we get from Morningstar. So it will also include pension funds and from insurances as well. On top of that, we look at newspapers, we look at websites, and last but not least, at the UK Register and the Rechenschaftsberichte, which is more relevant for German companies. So overall, we track around about 35,000 equities, and 8,000 of these are based in Europe. So looking at these numbers, you can see that the Western European investments trend towards the consumer goods, industrials and technology, and they moved away from basic materials, financials and healthcare, and the rest is about constant. For Germany, that is slightly different. be noted that the majority of the investments in Germany are around the DAX, about 80%. So obviously the companies in the DAX reflect a huge portion. So if there are a lot of, say, technology companies, then that has a big impact on the general investments of North American investors in Germany. And we've seen over the last 2 quarters, so that is Q3 and Q4, that North American investors actually pulled out of Europe and out of Western Germany. And in the last quarter, which is Q1, they have come back and they have increased their investments in general European stocks, but also in in German stocks. And here they pretty much trended right across the board, except for consumer services that was less, say, important, or they put a smaller focus on consumer services. So the key message for this slide definitely is that the North American investors are coming back, and that applies as well for Western Europe as it does for Germany. On the next slide, we take a closer look on the ADRs. So if we move the slide one forward. Sorry. Looking at ADRs, and obviously that covers also the GDRs. The same thing for 3 quarters as of last year. The North American investors decreased their positions, and there was a massive increase in Q1, and here especially in energy. For technology, which is also a big investment, you have to bear in mind that big companies like SAP and Deutsche Telekom that have a big presence in the US are very relevant for the German market, of representing German investments for North American markets. And the second sector obviously is healthcare, and then with Fresenius and Fresenius Medical Care also very active in the US, and that makes a big impact as well as Bayer. Here we see a similar trend as we did in the general investments by North American investors. The same applies for GDRs and ADRs. Now, something that's probably very interesting for the corporates here in the room is where should we go? And basically, I can't break any revolutionary news. It is the West Coast and the East Coast that you should go and see. If you just add up San Francisco and Los Angeles, for example, they make up almost the same as New York. But then obviously when you're in New York, you would also see investors in Boston. So yeah, definitely when you go and have a trip to the US, you need to cover both markets on the East Coast and on the West Coast. When you look at Philadelphia, which is a big investment, you have to bear in mind that Vanguard is there, and they're an index investor, so you have to take that with a pinch of salt, whether it's worth the trip or not. For San Francisco, obviously, San Francisco is very big for hedge funds, and that's a decision that every corporate has to make themselves, whether they want to see hedge funds or to which extent they want to see them. And there are like BlackRock, which is a big passive investor. So you know that gives the numbers a slightly different spin. And for the ADRs and GDRs, it's the same message here. And for Western Europe, New York and San Francisco and Boston are the areas where the most investments are. And for Germany or German investments, it is San Francisco and obviously, as I said, the New York area. One thing that our analysts pointed out, that in San Francisco, for example, you have Fisher Investment. They are not a passive investor. They are not an index investor, but they take very, very few meetings. So even though they manage a whole lot of money, you basically have to subtract them from the overall money that is invested in the area, because they don't want to see you, typically don't want to see you. And then I don't want to go into the details here. These are the top investors in the area of North America. be careful not to mix up the BlackRock fund advisors and BlackRock advisors. Obviously, they behave very differently, and you have to pay attention to the detail whom you're actually seeing or you should be targeting. And then on the next slide, you see the same for the ADRs, an overview of the Western European equities, where you can look yourself which are relevant for the common stock and which focus on GDRs and ADRs. So that's basically the conclusions that we drew from analyzing our data. And obviously, no surprise, North America is very important, but I think you have to pick your battles. You have to really look where you're going, and I'm sure Rodney can tell us a whole lot more about that going forward.
Thank you, Toby. Zaf, maybe we touched upon the ADR topic, and obviously we see that a proportion of the investments from North American investors are invested in that form. Could you just give us a few hints on how to treat that category and whether these investors need to be addressed any differently?
Of course, yes. Thanks, Katja. Obviously, talking about the North American landscape, you can't talk about the North American landscape without talking about American depository receipts. And American depository receipts have been around a very long time, since the 1920s. There's a long history. We saw in the 50s a lot of ADR programs being set up by South African mining companies because Americans couldn't physically buy gold, so they needed to get exposure to the gold price. So we had a lot of ADRs created in the 50s. In the 1980s, we saw a lot of privatizations around the world where there'd be a secondary offering in the US. And then more recently, past 15 years, we really see the emerging markets interested in the depository receipt product, mainly through GDRs, but also ADRs, particularly from China, listing it in New York. So there's a long history of ADRs. It's been around a long time. It's not a new product. Now, why bother with ADRs? People always say, well, people just invest in the ordinary shares. Why would you invest in ADRs? We have big international investors, settlement systems emerging, there's electronic trading. Why bother with ADRs? Well, every year we see increased activity. We see still a renewed level of volumes going through. And maybe if we just refer to slide 1, which Katja covered initially, where we talk about the amount of money that's going into depository receipts. It's 1.3 trillion. So you can see the size of money is pretty substantial. And in addition to that, there are about 2,000 ADR programs from 80 countries around the world. And in terms of volume, you're talking about 3.1 trillion in terms of value, about 156 billion worth of DRs traded last year. And in terms of capital raising, around 11.5 billion capital was raised using depository receipts. So you can see it's very much a relevant product just by the volumes and the amount of money that's invested in this sector. Now, which companies invest in ADRs? It's a whole range. It's companies with a US focus. You may want to have brand recognition in the US. You may have operations. And of course, there's particular sectors that are very much popular with the US investors, particularly around biotech, for example. We've seen a lot of interest around biotechs recently. Now, in terms of German corporate history, a lot of listings occurred in the late 90s. A lot of DAX 30 companies listed on the New York Stock Exchange. Following the passing of Sarbanes-Oxley in the US in 2002, a lot of companies delisted because the cost of compliance was very high. Volumes weren't particularly great. So a lot of companies in Germany took the view they would delist, but they didn't get rid of their ADR programs. They moved to a sponsored level 1, which is traded on the over-the-counter market in the US. So the ADR product still exists for these companies. And what we've seen recently is a bit of a renewed interest in US listings because a lot of companies are thinking strategically. So if you look at history in the past, the largest acquisition of a US company by a German company was Deutsche Telekom. So they acquired VoiceStream Wireless about 15 years ago, quite a long time ago now. But it was a $50 billion acquisition using depository receipts. Deutsche Telekom were listed at the time, but it was a real significant transaction. Obviously, Deutsche Telekom is now delisted, but we still see a lot of companies, if they're interested in a US acquisition, the ADR listing can be a very interesting and important component. And you've obviously seen the news recently about Bayer and Monsanto. buyer doesn't have an ADR program, it doesn't have a listed program, but if they did, the transaction may be easier to handle, sort of question for them. But you can see it's still very much a relevant product. There's also something called unsponsored ADRs in the market. So that is where a depository bank doesn't actually have a contract with a particular company. You have 4 depository banks in this business. And based on broker demand, a depository bank can set up a sponsored program and generate activity through US investor interest. And a lot of companies look at the unsponsored and don't like the idea of having no control over ADR activity, and companies like Nordea, for example, have moved to a sponsored program from an unsponsored. So that's quite a sort of standard route. Now, in terms of investors who invest in ADRs, it's a broad range of investors. It's pension funds, it's hedge funds, retail. But what we've seen recently is a real interest, a significant interest in private wealth management, particularly a particular product called separately managed accounts, and that's provided a lot of interest from US investors who typically invest via that route. A lot of institutions have a particular ADR-focused fund focused on that sector. In terms of other investors, there's also employees. You have 401k plans. There's options over ADRs. So a lot of companies have those if they have substantial US operations. So what is the aim of an ADR is really to provide you with a tool for investor relations. And the aim is really to get 1 to 3% of your issued share capital in ADR form. It's very rare that you'll get something beyond that. If you're a listed company, obviously the figure is a little bit higher. So what we're talking about is incremental demand. And that's where the ADR product actually helps market yourselves, having a slide in the back of your presentation, having an ADR ticker symbol on your press releases, having some of the research reports actually referencing the ADR. Deutsche Bank, every company that has an ADR program, and Deutsche Bank writes research on them, has an ADR ticker symbol indicated on the research report. So all those little things really matter in terms of getting the information out there. In terms of targeting, I'd say there's no such thing as an ADR-only roadshow. You should do it in conjunction with your normal US roadshows. And I think it's important to use your depository bank to highlight those institutions with an ADR orientation, and that will allow you to tap into that incremental demand. In terms of where you should go, Rodney will come on to this a bit later on, but in terms of the pool of money, about 36% of investable assets is held in New York and Boston. So 36% is quite a substantial amount. And then on the West Coast, LA and San Francisco account for about 13%. So you can see East Coast, West Coast is really important in terms of ADR pools. But there are other locations. I think Rodney will cover that a bit later on. There's also other tools that you can use. Deutsche Bank, we actually have a virtual investor conference we've set up, which has been really successful. That's allowed companies to sit at their desks and access US investors during a half-an-hour presentation over the internet. People register and listen to people's presentations. There's a chat facility available. Very, very popular amongst German corporates. So one of our DAX 30 clients has now done it 7 times. So a lot of interest there. So in summary, an ADRs is really a proven way to market your equity story in the US with the aim of increasing your overall US share ownership. So it's really a tool.
Thank you, Zaf.
Okay.
Maybe over to you, Severin, giving us the view from the consultancy perspective, as you're talking to a lot of European companies on a daily basis. What sort of observation and comments can you give us on the different factors to be aware of and that you make your clients aware of when dealing with North American investors, talking maybe about the attitude to risk, the valuation, the way they screen their investments? Do you have any hints for us?
Thank you. Yes, surely, Katja. I guess if we talk about, for example, risk appetite, without wanting to generalize, I think you can say that in general, there is probably a greater appetite for risk from US investors. Now, it's probably down to their business and capital market culture. And it goes back to what has been said around, for example, certain interest for sectors such as biotech. So that's probably one observation. The second observation is whenever you would look or investors would look at a certain categories of stock. I'm just taking maybe the example of a client of ours who recently who is about to list and recently went on a roadshow in the US as part of the listing preparation, and they're going to position themselves as a growth stock. And the CFO was telling me that the difference between European investors, for example, vision towards aspects such as leverage was quite differently from what a US investor would say. And the US investors would tell them, you can go around, you can go around 2 or above 2 or above 2.5. We want you to grow. We want you actually to invest as well. So that's probably one factor to bear in mind, is that from a sector prevalence, or let's not necessarily talk about sector bias, but sector prevalence, and also, I guess, general attitude to risk, there is probably a greater magnitude in terms of approach to risk. That's the first element. The second element, maybe, it's to talk a little bit about hedges, and I'm sure you will have a lot of things to say. And I don't really want to enter into the debate about what you are doing, but it's, as we've seen, quite a substantial amount of money from the hedge funds invested in the US. These people can be even driven, but I think more generally they're looking for alpha. And from that perspective, on the one hand, or that's at least what we have noticed, is they will put quite a lot of money into looking at the companies they want to invest in. Some hedge funds might, hire, a company to do forensic accounting in order to really dig very deep into the company or into the stock they're about to invest. The second element, and I guess that it would be interesting to hear that, is what I've noticed in my past experience is that they also they also actually almost act as hordes, right? They are not going to hide investment ideas from one another. In particular, the US-based hedge funds, they will call one another, and actually, if they have an idea, they're going to try to basically act as a herd, which is probably a sign that one should pay attention to when things like that happen. In general, be it for, I guess, generalist and specialist investors, because of the time difference and because, I guess, the culture are also different, all the US investors we talk to are very much adamant about, I guess, asking for very transparent, I mean, it's nothing new, but I think it's one point to get across, very transparent and continuous disclosure and communications from European-based companies. This is, again, down to the fact that they also have quite a lot of potential investment on their radar screen, and they are not necessarily very able to reach the IR. I would be interesting to hear your view about, interactions. I guess US investors are used to interact in a certain way with US IROs because of regulation FD. We don't have that in Europe, so that's also might influence the way they, I guess, they interact with European-based company. And then I guess the last point is around, I mean, it's a pragmatic approach, is if you're a DAX company or if you belong to a large index, the chances that you're going to be picked up as an investment from US investors is quite high. So the question is, what happens when you are potentially below certain, market cap thresholds or liquidity thresholds? Depending on the sector where you're in, you're going to be picked up, or you're going to be on the radar screen of, I guess, sector specialists. And here, that's, again, the onus on the IRO to benchmark himself or themselves against potentially a larger comparable basis. But I guess that's also probably a question that's going to come around targeting, is how do you deal with building an IR program when you are not necessarily one of the usual suspects? And I think that's also making sure that you take, I guess, this benchmark in your own hand and try to probably see, I would say, beyond just the sector element, but more, the profile of your stock and how this can attract potentially an investor base that is not necessarily knowledgeable in the sector. But I think it takes also quite a while to build up recognition and volume in the US. So that would be my talking points.
That's a perfect transition to Rodney. I think we're all waiting to hear how you put all these principles in practice and how you made it a success for Nordea. Over to you.
Thanks, Katja. Yeah, if I just may step back and actually talk about Nordea, we are then the biggest Nordic bank in the region. We have a market cap of around 35 billion euro. When our CEO is a bit naughty and nasty, actually says that we are twice as big as Deutsche Bank. That's very unfriendly thing to say, but that's the truth. So we are quite a sizable bank. And also, if you look at the name Nordea, it stands for Nordic Idea. And that comes from the fact that we were 4 banks in the region merging some 15 to 20 years ago. So we are, from that perspective, very different from our Swedish and Nordic peers, because we don't have really one home market. We have 4 home markets, and our biggest market represents 27%. With other banks, it's typically 70 to 90%. And when I was an analyst, I always found it difficult to talk about Nordea, because they were basically all over the place, and typically investors want to have themes and thesis, what to invest in, and Nordea didn't really have anything, because we were all over the place. So if you wanted to have an exposure to large corporate banking, you had one bank. If you want to have Swedish mortgages, you had another one. If you want to have Norway and so forth, and we were always a bit in between. So my first thing was to try to find out the financial branding. Who are Nordea and why should you invest in Nordea? Because in my mind, to create a financial brand is just like create any brand. And you need to, because investors, they can invest in 100 to 300, 500 different names. And therefore you need to have something that okay, when I think Nordea, what should I think? So what we did then was to look at, okay, why should we really invest in Nordea? And then we found out that, we were an extraordinary stable bank. As you know, the banks have had a lot of challenges in the last 8-9 years. And we have managed with our diversification and risk management to have a very, very stable earnings and a very stable capital base. So that has been our key selling point to the investors. So I mean, when investors think Nordea, we want them to think stability. So that's the financial brand. The second step was then to, okay, which investors would be interested to invest in a feature like this? So then we did a quite thorough investor targeting. We took help from some external consultants, and okay, where should we focus our resources? Because I also found out the first road shows we did, especially to New York, but also London, was that we got the schedules from the brokers, and they were all very fine, and it was from 8 to 5 and so forth. But we didn't really feel we met the relevant investors. And of course, when you ask a broker to set up a schedule, what they will do is that they will put you in front of the best commission payer, and that's not necessarily, and that's the right thing from their point of view. So no criticism, but I mean that's not necessarily what you want to who you want to meet. So we did this thorough targeting analysis. And then now when we do the roadshows, we have a very detailed request. These are the one we want to meet. And if a broker failed to meet those expectations, we will not use them anymore. It's as simple as that. So we work very closely together with that. So that was to do this targeting analysis. And then we also found out some interesting things. Because, as you showed here, Patrick, that, New York is huge. But we found out that New York was not the most interesting market for us, because when we did the targeting study, we found a lot more interesting names in Toronto, in Philadelphia, and in Kansas and things like that. So we started to travel to those markets as well. Usually you do New York and Boston. Now we basically only do New York when there is a conference in New York, because then it's the most efficient way. We meet New York accounts, but we also meet a lot of other accounts. And actually, when you look at the investor base now in North America, we have the biggest investors in Toronto, in Philadelphia, and in Kansas. New York, we have a few, but they're not that big. And that's because the nature of the investor base. And then, of course, when I then started in Nordea also, we found out that we had a very low or small investor base in the US. Then you can say it's not necessarily important to have a big investor base in the US, because we only have 4 billion shares. And if they want to buy, someone has to sell, and that's not necessarily positive. So therefore, we didn't set a target that we should have X% shareholders in the US. But instead we said that we want to find the right shareholders, and then we want them to have as long-term fan investors. And then we also found out that, you know, as I said, we had a weak shareholder base in the US, and the reasons for that, there were a number of reasons. First of all, they didn't like our equity story. They didn't know why should we invest in Nordea. Then there was also a pure personal thing, that they didn't believe in our equity story. They thought that we are way too optimistic. We are in phase of denials, and they didn't know, why should we trust in you? You only come with the good news. Give us the risks so we can assess them. So we changed the story quite a lot from being, you know, selling our story to really, you know, okay, this is where we are, these are the risks, these are the opportunities, this is how we handle the risks. And of course, we've also, which goes without saying perhaps, but I mean, all smart investors, they know how to avoid the wrong risks. They can take the right risks, but never the wrong. And in order for them to make that judgment, they need to know that we also know who are the wrong risks and are the right risks. So we changed the messaging quite a lot, and in order to try to address the issues that the US investors had. We also found out that, I mean, in US, I mean, we are a 35 billion euro company, but for them it's not really interesting. We could be a 3 billion euro, 300 billion euro company. The most interesting thing, because they don't really care about index. I mean, we should be small or big, but they want to find a good investment case. While in Europe, you typically, as a 35 billion euro company, we will meet all relevant investors wherever we go. But that's not typically the case in the US. You need also to gain their confidence. So when we started, I joined in 2009, and then we had 3.4% shareholders in the US. As you know, it could be difficult to look at US versus UK, and sometimes they interact, but 3.4 registered in the US. And we thought that that is way too little. It's the world's biggest financial market, so we need to have a bigger presence there. So we took a number of decisions. First was to have this sponsored ADR program that gave us more insight and that gave us more resources to invest into the US. And then we simply, as I said, changed the messaging. We were much more focusing on addressing the issues that the US investors had. And then we started to travel. So we have traveled a lot into the US. And we have been so many times in places like Des Moines, you know, Butarakan, and names, you know, why should you even be there? But it's actually been working quite well. Well, as I said, when it comes to New York, we are typically there when it comes to the conferences, and very seldom otherwise. But we spend a lot more time traveling to the smaller markets. And we also found out that we got a lot of interest from many investors, but they didn't want to invest in us because they didn't think the price was right or the valuation was right. So we also found out that, I mean, you need to be really patient. You need to meet them several times, and you need to build confidence, you know, over time. So the first 3 years, not much happened. We got a small increase, but then there were two things happening, or especially one thing happening in 2013. That was the biggest shareholder in us, which was the Swedish government. That was a legacy from the financial crisis in 91, 92. They divested 20% of the shares in 3 tranches. And then a large part of that, actually 97% of that, was placed outside the Nordic, and the majority was placed in the UK and the US. That was the first thing. And then also we managed finally to, you know, build this long-term confidence. And I mean, I've been in frequent meetings with investors, you know, 10, 12, 15 times. And then after 2 or 3 years, they started to buy. So now we have approximately 15% of the shareholders in the US. And as I said, that's not, I mean, the key thing is not that we have 15% in the US. It's worth as much to have 15% in Germany. But we also think that we have a good investor base. They are long-term. They are fan investors. They know our stories. And as you mentioned, Severin, I mean, you also have hordes, and they are talking to each other. So the reputation and the financial branding has increased. And I think that's more important, because shareholders will come and go. But to have this long-term relationship with investors, that's been our key takeaway.
Thank you, Rodney. I think maybe from a time perspective, practical, how did you get your management on board with this exercise? Because, you know, what you're describing is a very long journey to get, you know, once you targeted the investors, to build their confidence, etc. Did you just go by yourself at IR level? Did you take your management with you? How did you allocate your resources as an IR team?
No, this is an IR exercise. It's an IR exercise. The top management we basically only get to the conferences. we have now it's 3 conferences, 1 local and 2 global, where we participate in, and then we have CEO, CFO, similar. So for instance, Deutsche Bank next week having in New York, and then me and the COO will be there. So they're basically doing that. Then maybe once or twice per year we do also quarterly presentations in New York and Boston. That's what they are doing. The rest is done by IR. So last year we had I had 9 roadshows, and my colleague had something like 5 or 6. So some 15 roadshows.
Because, I mean, we hear a lot, and we heard it, I think, at one of the sessions yesterday, that, you know, the investors want to look the management in the eye. So when do you have that meeting? Does it happen at a conference, or how do you make sure that, or do the investors that that invested in Nordea decide to look in the eye, look II in the eye, and that was enough?
They've looked me in the eyes, yes. No, but it's different. I mean, for instance, we have one of our biggest shareholder is based in the very exotic place of Santa Fe. Please go there, it's very nice and exotic. It's like going into a John Wayne movie. So we started actually by having a conference call with the CEO. So that was the first thing was that I was traveling there, and then some months later we had a conference call with the CEO. And then I've been there quite frequently, and now they're on board.
I think this is, I have a question which is for Severin and you, Rodney, and maybe Zaf as well can step in from a ADR perspective. But, you know, we heard some companies and some of the DAX companies have a US-based IRO. Now, you don't have that. How, you know, what do you think? Do you think it would have been helpful to have a US-based IRO? And then maybe, Severin, you worked at companies which had a US-based IRO, so give us that perspective.
Yeah. First, to start with your first question, I mean, is it enough if IR goes? And I think what investors, and I found it out very easily as an analyst itself, you can easily smell if the IR is centrally located or if it's just an administrator telling a corporate story, or if it really can give you the flavor. So, I mean, it depends on how you want to use the IR within the group. When I joined Nordea, they made it very clear that, you know, the CEO and the CFO, they want to run the bank. And then they gave me the outsourced everything to the IR department. So that's the first thing. Then when it comes to the US, I've been struggling with that a lot. But I think my key takeaway is that, I mean, it's crucial, coming back to my previous comment, that you are centrally located, that you're in the center of where things are happening. And for us, having an IR in the US, he could perhaps spend more time on the roads, but I think it will be farther away from where the action is, so to say. So we have decided not to use that. I've talked to some of my peers, and they basically come to the same conclusion. A few of them has tried to have a US IR, but they've come to the same conclusion that it's you can spend more time, but the confidence is less.
I think actually from our experience in terms of the ADR clients we have, a lot of companies have US-based IROs if they have substantial operations there, or if there's a previous listing that just sort of justifies them being there. So I think it very much is a case-by-case basis, but it really does help if you have substantial operations. It really justifies that person being there. And we see companies in the oil industry, pharmaceuticals, that typically have US-based IROs. But a company like Nordea that actually doesn't have a US presence at all is much harder to justify, even though you're finding a lot of interest.
And when I used to work at Deutsche Telekom, we obviously had historically actually quite a strong US shareholder base, first of all. Secondly, there was actually a retail component. So that's something we haven't really discussed, but that was quite strong within DT. And thirdly, obviously with the VoiceStream deal, the rationale for having somebody on board, based there, to actually make the link also with the US operation, going back to your point about being centrally located and knowing the operation was even stronger. So I think that was a very strong rationale. I worked in other companies, like when I was at Thomson in France, we had actually, I think, more than 60% of our revenues were derived from the US. We own brands such as Technicolor, but in that case, we managed everything from France because it was one central investor relations team. So I think it goes back to that point.
Okay. I think we can open to questions from the floor if there are any. If not, we'll continue. Is there anyone that wants to ask a question? Very quiet. Okay. Well, okay, over there. Thank you.
Question for Rodney. Could you share with us what your experience is from moving from an unsponsored ADR program to a sponsored? Is there any difference in investor attention? Question one. And the second one, what is your experience or what is your view on trading liquidity? I mean, ADRs, do they increase the overall liquidity? Do they split it? Or maybe helping to increase the liquidity in the ordinary shares? If you could share that with us.
Yeah. Now, on the first part, first of all, in terms of liquidity, we have seen an increase in the trading of ADRs when we got it sponsored. Then we have the sponsored level 1, so we don't have the more advanced one, but we have the level 1. We think it's better suited for us. So we clearly found out that the trading was better. Then, the total program is 100 million shares, and we have 4 billion shares. So it's a small part of our total. So it has not really affected liquidity. But the second advantage is also that we got a better understanding of the investor targeting. That's clearly helped us to really focus our resources better and to get more resources to invest in the US. And then of course you have these virtual conferences as well, which we have tried to participate in once or twice per year. That has also helped us. So combined it's been helpful, but in terms of the total program, it's 2.5% of the outstanding shares.
Yeah, one question to Safar. First question, you said quite clearly that there's no such thing as an ADR-focused or ADR-only roadshow. Why do you think so? And sorry, just second question to Rodney. What's your experience with brokers organizing roadshows in the US? Do you prefer European brokers or US brokers for that?
Okay, first question. Yeah, I mean, that's a very good question. I mean, typically, when you meet an institution, there's no sort of ADR portfolio manager. It sort of doesn't exist. You have a portfolio manager that manages the international portfolio. It could be several mutual funds. So you meet that person as in like a normal roadshow. So if you're meeting the big institutions, I don't think there is a particular way you can have an ADR-only roadshow. I mean, there are private wealth management firms out there that typically invest in ADRs, but that's a different type of conversation. So I think, on the whole, you shouldn't really change the way you handle roadshows. It should be the normal institutions you meet. And then if you have an institution that has an ADR orientation, then it's worth mentioning in the meeting that, if you have an ADR, we have an ADR program. If you have any investments going into our company, then please, that could be one route. So I think it's an issue that has come up very often with companies. They say, can we do an ADR roadshow? Very hard to manage, very hard to organize because they sort of don't exist. So I think that sort of answers your question, hopefully.
And on brokers, well, as I said, we participate in 3 conferences, and then when it comes to the different parts, we use different. I mean, in Canada, we think RBC is the best. It's very simple. And then when it comes to the rest of the North America, the US, we typically use North American or US brokers. Then you can say the issue with the US brokers, especially if you go to New York, maybe Boston, but especially New York, is that they want to put you in front of the best commission payer. That's more obvious in New York than in Europe. So you need to have some shorter leashes there, and you need to control that better, because otherwise you can fail to meet the person you want to meet.
But actually, I'm interested. So in that case, for example, with RBC or the US brokers, do you have also sell-side coverage from these guys, or is it actually going sometimes to brokers that don't follow you on the sell side?
No, we have one requirement, and that is that they should have a good active coverage.
Okay.
Then they're typically done from London.
Yeah.
But we don't care about the recommendation. They could have sell or whatever.
But you would have a sell side in-house that would be knowledgeable about the stock.
Yes. Yes, we found that very important, because otherwise, it's important that the analyst also can educate the investors.
Yeah.
So that's important.
Maybe a follow-up on that. I mean, how would you do it? Nordea is big and significant in the Nordic markets, and we heard market cap higher than Deutsche Bank. So, how would you do it if you were sort of mid-cap? Because you know, if you have the luxury of size and you can keep the brokers on the tight leash. Now, if you look a few years back, maybe you were not able to do that. How would you recommend? You know, maybe a company that has less of that bargaining power manages the brokers and goes about targeting and roadshows in the US and in Canada.
Yeah, but I think it's important to understand the business logics. As an ex-analyst, I can tell you that the last years, we assessed that around 35-40% of the revenues came from corporate access. So that means that we are, as an IR, we are a very important component in their product offering. So that's why we have the bargaining power. I mean, and that's why, I mean, regardless of their market cap, if they don't understand that business logics, then you should not cooperate with them. Because we are the one bringing value to the brokers and not the opposite. So therefore, I mean, keep them tight.
And Katja, if I may add one thing, lots of our clients say they are not short of opportunities to go to the US, and they probably could fill 200 days of roadshow, seeing, as we know, it's a huge amount of money out there, and they could see plenty of people. The question is to meet the right people. So, Safa, we had that conversation yesterday. It's like nobody would dream of sending an email to Amazon and say, send me a washing machine. You know exactly what you want. You say, I want exactly this washing machine. It has to do this and that, and this is the machine I want. Because at the end of the day, you're picking up the tab. And that's what we recommend to our clients as well. They do a thorough research, and the broker is your partner, and together it will end up that both parties are happy, because you cannot cut the broker short and say, like, do this and he's not happy, then you won't do it again. Whereas if you just follow the commission of the broker, you won't be happy, and that is the sort of careful path that you have to track.
But I guess it goes down to, I mean, what you were saying. You didn't have a certain threshold in mind, and why do you want to go to the US? In that case, that was also to, if I correctly understood, to target also a stable investor base, right?
Yes.
So why is it that you need to be in the US? Is it because indeed you need to diversify your shareholder base? Is it because you want to go after a certain type of investors? Is it because you know that you're going to do M&A in the US and you need to start, spreading the story? So it goes back to, what is it that your investor relations goal or strategic goal are? And from there on, this can dovetail into actually targeting the right people with the right attribute on the sector, on the stock profile, on maybe affinity with the brand if you are very well known in the US. And I guess that also answers maybe part of the questions around even if you are below a certain market cap, you have tools, but I guess it's much more in your own hands than potentially in the hand of the brokers.
Yeah, I think what could be interesting to hear about the panel about is the style of investors, because I think one of the differences between the US and the US, North America, I mean Canada as well, and Europe, is that investors stick much more to a certain style. So the definition of value, the definition of growth. When in Europe you have more of this GARP style. So have you sensed that? I mean, Rodney, maybe Séverine as well, when you're working with clients in your targeting, has that been very important?
Go ahead.
Okay. I never understood this split up of investor style. I mean, as a company, the only purpose we can have as a company is to create value. So we are a value stock. Then if we come via growth or via other opportunities, I mean, I never understood that. And I also never understood, that you have hedge funds here and long-only funds. I mean, a hedge fund is not a hedge fund. You have 1,000 investor styles within hedge funds, and some of our biggest fan investors are hedge funds. I love meeting hedge funds. I think they are extraordinarily important for the overall investor community. And I mean, the discussions are usually much more in-depth and knowledgeable not often, but it's often more knowledgeable and in-depth discussion about the company when you meet the hedge fund. So I never really understood why you look at different styles. I mean, when it comes to us, are we a growth company? Absolutely not. We have said to all our investors, you should not expect us to grow top line. Because, I mean, we are a bank and we are part of the financial or the society. So for us to grow faster than the economies we are working in, it's just value destroying. So we say to them, don't look at us as a growth company, but then we can create growth bottom line because we are focusing on efficiency. And then we create growth in our equity because we have a 12-13% ROE. That means that our equity growth by the same magnitude. That's quite decent growth. So you can define growth in different ways, but at the end of the day, it all comes down to create value. So we only meet value investors.
Okay.
Actually, in terms of investment style, another issue we're coming across is a lot of companies are talking about passive investors. You know, before a passive investor would appear in your share register, you wouldn't bother meeting them. But we're seeing a lot of companies now trying to engage with them, particularly with the rise of ETFs. I mean, over the past 10 years, I think we've had a rise of 8% of investable assets going into passive management, up to 14% now. It's really substantial growth. But do people in companies engage with them, particularly around voting at AGMs? Because obviously there's been a lot of contentious resolutions around, including Deutsche Bank. But we have just want to find out whether you do engage with passive investors just on the voting side. Is that something you see?
No, we have not done that. We have been in the luxurious situation that we have not had any real controversies with the investors. So, for instance, before this AGM, we discussed whether we should have proxy companies or things like that, but we decided not to. Right. But that could, of course, change. And what makes me a bit nervous is that, I mean, you should build a relationship in good times, not when things are heating up. But we have decided not to do this so far.
Interesting.
But that's something we clearly are looking into whether we should.
I think we have time for one last question from the floor, if there is one. Otherwise, okay, if no burning issues are outstanding, I would like to thank you, our audience, and thanks our panelists for a very interesting discussion. Maybe just a couple of things that I took off from the conversation is that, I mean, obviously the US is large, but you have to distinguish the various targets you want to spend your time with and the right investors for you, and need to be extremely patient, as it takes sometimes a few years until it comes to fruition. The depository receipt product helps to increase the investment pool, so having that as part of your IR toolkit is an option, and it should not be ignored. And then, targeting investors is key. You need to pick your battles, as Toby said, and make sure that you maintain the relationships in good and bad times. So thank you very much for listening, and thank you to our panelists once again. Thank you.
Thank you.